VIP John AG here. JP Morgan Chase is sitting on a derivatives book tied to precious metals that is valued at over $1.8 trillion. Let me say that again. $1.8 trillion in precious metals derivatives held by a single bank. That number comes directly from the Office of the Comptroller of the Currency, the OCC, a federal regulator. This is not speculation. This is not conspiracy. This is documented, audited, public data. And when you understand what that position actually means, when you connect it to what is happening right now in the silver market, in the gold market, in the COMEX vaults, and on the Shanghai Exchange, you will understand why the mainstream financial media will never, ever break this story down for you the way I am about to do right now. Because if the public truly understood the scale of what JP Morgan has built, the entire illusion of free and fair precious metals pricing would collapse overnight. So stay with me. Every single dot connects, and by the end of this video, you will see the full picture. Let me ground this in what is happening right now. Silver is trading around $32.50 on the COMEX. Gold is hovering near $3,230 per ounce. These are numbers that 5 years ago would have seemed extraordinary. But here is the thing. When you adjust for inflation, when you account for the actual supply and demand dynamics, and when you factor in the level of monetary expansion that central banks around the world have engaged in, these prices are not high. They are suppressed. And the mechanism of that suppression is exactly what we are going to dissect today. Now let us talk about the COMEX, because that is where this story begins and ends. COMEX registered silver inventory has been declining for years. We are currently sitting at roughly 137 million ounces of registered silver in COMEX vaults. Registered means it is available for delivery against futures contracts. That sounds like a lot until you realize that JP Morgan alone controls a derivatives position in precious metals that dwarfs the entire physical inventory of the COMEX by a factor that is almost incomprehensible. The notional value of their derivatives book could theoretically lay claim to multiples of the entire global annual silver mine supply, which sits at around 830 million ounces per year. Let me be crystal clear. We are talking about a paper position so enormous that there is not enough physical silver on the planet to back it. Not even close. And here is where the data gets really uncomfortable for the establishment. The Shanghai Futures Exchange, the SHFE, is consistently pricing silver at a premium to the COMEX. Right now, the Shanghai premium over COMEX is running between 3 and 5%, depending on the contract. That premium has been persistent. It is not a one-day anomaly. It is a structural signal. It is telling you that physical silver in Asia, where actual industrial consumption is exploding, is worth more than the paper price being set in New York. When physical markets diverge from paper markets, one of them is lying, and I will let you guess which one. Gold is telling the same story. Shanghai gold premiums have remained elevated. Central banks, particularly the People's Bank of China, have been accumulating gold at a pace not seen in modern history. China has added hundreds of tons of gold to its official reserves over the past 2 years alone, and most analysts believe the unofficial number is significantly higher because China routes purchases through entities that do not report directly. Russia, India, Turkey, Poland, Singapore. The list of central banks buying physical gold and repatriating it from Western vaults keeps growing. They are not buying paper, they are buying metal, and they are taking delivery. Meanwhile, on the COMEX, the open interest in silver futures remains elevated while the deliverable inventory keeps shrinking. We recently saw delivery notices spike in the active month, with standing deliveries pushing well above seasonal norms. The people standing for delivery are saying something very specific. They want the metal, not the cash settlement, not the rollover, the metal. And the COMEX is having to work harder and harder to source it. Now let me connect this to the macro environment because none of this happens in a vacuum. The Federal Reserve has kept interest rates elevated, but the market is increasingly pricing in that the next move is a cut, not a hike. The dollar index, the DXY, has been weakening, trading around 99 to 100, and that weakness is providing a tailwind for gold and silver priced in dollars. Inflation remains sticky. The official CPI might say 3%, but anyone who buys groceries, pays rent, or fills a gas tank knows the real number is significantly higher. And when real interest rates are negative, which they effectively are when you use honest inflation data, gold and silver become not just hedges but essential portfolio components. Bitcoin is trading near $107,000, confirming that the broader macro trend is toward hard assets and away from fiat currencies. I track Bitcoin not because it competes with silver, but because it confirms the thesis. Capital is moving out of the system. Whether it goes into crypto or precious metals or both, the direction is the same. Away from trust in central banks and toward assets with finite supply. Now here's where it gets interesting. Let me talk about what J.P. Morgan has actually done. Because this is not just a story about a big derivatives book. This is a story about strategy, control, and positioning that spans over a decade. Looking at the numbers, about 75% of you watching right now are not subscribed. If this kind of unfiltered, data-driven analysis is cutting through the noise and giving you clarity that you are not getting from the mainstream financial press, hit subscribe. That is how we grow a community built on truth, not hype. Drop VIP John AG in the comments so I know you are part of the team. If it is not for you, no hard feelings. I do not chase empty metrics. I do not sell signals, mentorships, or courses. I just break down the data. Now let me get to the smoking gun. And this is the part that ties everything together. J.P. Morgan was fined almost $920 million by the Department of Justice for spoofing in the precious metals markets. Let me say that number again, $920 million. This was not a slap on the wrist. This was the largest penalty ever imposed for trading manipulation in precious metals. Multiple traders were convicted, including managing directors. The DOJ documented thousands of instances of spoofing, which is the practice of placing large orders with the intent to cancel them before execution in order to move the price in a desired direction. They did this systematically for over 8 years across gold, silver, platinum, and palladium markets. This is not a conspiracy theory. These are federal convictions, court documents, guilty pleas. But here is what makes this truly insane. While they were manipulating the price downward through spoofing, while their traders were committing documented federal crimes to push prices lower, J.P. Morgan was simultaneously accumulating the largest physical silver stockpile in modern history. At its peak, J.P. Morgan held an estimated 150 million ounces of physical silver in its own vaults. They were suppressing the price with one hand and buying the physical metal with the other. Let that sink in. They paid a $920 million fine, which sounds enormous until you realize it is a rounding error compared to the profits they stand to make on a position of that magnitude if silver ever reaches fair value. And here's the connection to the $1.8 trillion derivatives book. That derivatives position is not just a speculative bet. It is a control mechanism. When you hold a derivatives position that large, you have the ability to influence price discovery itself. You can use the paper market to set prices that have no relationship to physical reality. And as long as the majority of market participants settle in cash rather than demanding delivery, the system holds. But the moment delivery demand exceeds available supply, the entire structure fractures. And that is exactly what we are seeing the early stages of right now. As I said in the previous video, the COMEX was not designed to deliver metal to everyone who holds a contract. It was designed as a cash settlement mechanism where maybe 1 to 2% of contracts result in physical delivery. The system works as long as almost nobody asks for the metal. But what happens when 5% want delivery? 10%? The math breaks immediately. And with registered inventory at current levels, it would take a surprisingly small percentage of contract holders standing for delivery to create a crisis that the COMEX has never seen before. Now let me talk about physical versus paper, because this contrast is the heart of everything we cover on this channel. If you go to a major online dealer right now and try to buy Silver Eagles, you are paying a premium of anywhere from $5 to $8 over spot depending on quantity. That is a 20 to 25% premium on a product that the U.S. Mint produces. Silver rounds from private mints carry premiums of $2 to $4. Even 1,000-ounce bars, the institutional product, carry premiums that were unheard of 5 years ago. Delivery times on certain products are stretching out. Some products are on back order. The U.S. Mint has reported record demand for Silver Eagles, and multiple times over the past 2 years they have been unable to meet demand due to blank shortages. Meanwhile, the paper price on the COMEX says silver is worth $32.50. But walk into a coin shop and try to buy silver at 32.50. You cannot. The real price, the street price, the price at which physical metal actually changes hands, is significantly higher. This is the divergence that the paper market tries to hide, and it is getting wider, not narrower. The Shanghai Premium confirms this from the institutional side. Dealers confirm it from the retail side. Mints confirm it from the production side. Everyone in the physical supply chain is telling you the same thing. Silver is worth more than the paper price says, and the paper price is being managed. The industrial demand picture makes this even more compelling. Solar panel manufacturers are consuming over 200 million ounces of silver per year, and that number is growing as global solar installations accelerate. Electric vehicles use approximately 1 ounce of silver per vehicle, and EV production is scaling globally. AI data centers require massive amounts of silver for electrical contacts, connectors, and thermal management. Military and defense applications continue to grow. The electronics sector alone consumes hundreds of millions of ounces annually. Total industrial demand now exceeds 600 million ounces per year. When you add investment demand, jewelry, and silverware, total demand has exceeded supply for 3 consecutive years. We are running a structural deficit. The Silver Institute has documented this. And deficits in a physical commodity market do not resolve by magic. They resolve by higher prices, unless someone is artificially holding the price down. Now let me address the bearish case head-on, because balance matters. If you are bearish on silver in the short term, here is what you are looking at. The COMEX has the ability to raise margin requirements at any time. They have done it before during periods of rising prices, most notoriously during the run-up toward $50 in 2011. A margin hike forces leveraged longs to either post more capital or liquidate positions. That creates forced selling and can crash the price in hours. This is a real risk. If silver makes a sharp move toward $40 or $45, expect margin hikes, expect volatility, expect drawdowns that will shake weak hands out of the market. Additionally, if there is a broader deflationary event, a market crash, a liquidity crisis, or a credit event, silver can get caught in the liquidation cascade. In a true liquidity panic, everything gets sold, including precious metals, as institutions scramble for dollars to meet margin calls in other markets. We saw this briefly during the initial COVID crash, when silver dropped to $11 before recovering. So if you are holding silver, especially paper silver, you need to understand that short-term price violence is not just possible, it is probable. This is not a straight line up. It never is. But here is why the bullish case overwhelms the bearish case on any reasonable time horizon. The fundamentals have not changed. In fact, they have strengthened. Mining supply is flat to declining. Major silver miners are struggling with grade decline, rising input costs, and permitting delays. New mine supply takes 7 to 10 years to bring online from discovery to production. Even if silver went to $50 tomorrow, you would not see meaningful new supply for nearly a decade. Central banks are in an accumulation cycle. J.P. Morgan, after paying nearly $1 billion in fines for manipulation, still holds one of the largest physical positions in the market. If they thought silver was going to decline long-term, they would have liquidated that position years ago. They did not. They held it. And their derivatives book has only grown. The BRICS nations are actively building alternative payment systems designed to reduce dependence on the dollar, and gold is the settlement mechanism being discussed. Every ounce of gold that flows east, that leaves London and New York vaults for Shanghai and Mumbai, tightens the physical market further. The U.S. national debt is now above $36 trillion. Interest payments alone exceed $1 trillion annually. There is no mathematical path to paying this down without either massive austerity, which is politically impossible, or currency devaluation, which is politically easy. Every fiat currency in history that has faced this dynamic has been devalued. Gold and silver have survived every single one. If you have been watching this channel, you already knew all of this. But the J.P. Morgan piece, the $1.8 trillion derivatives book, combined with the physical accumulation strategy, combined with the documented spoofing convictions, that is the full evidence. That is the scheme. Suppress paper prices, accumulate physical metal, and when the dam finally breaks, be positioned on the right side of the most asymmetric trade in modern financial history. and the OGs in this community are positioned right alongside them. Not because we follow JP Morgan, but because we follow the data. And the data has been screaming the same thing for years. 3 key takeaways and we are out. Number 1. JP Morgan holds over $1.8 trillion in precious metals derivatives according to the OCC. This position gives them outsized influence over price discovery in both gold and silver. Combined with their physical accumulation and their documented history of spoofing convictions, this represents the most compelling evidence of structural market control in the precious metals space. This is not opinion. This is federal data and federal convictions. Number 2. The physical market is diverging from the paper market in ways that are becoming increasingly difficult to ignore. Shanghai premiums, dealer premiums, mint backlogs, and structural supply deficits all confirm that physical silver is worth significantly more than the COMEX spot price. This divergence cannot persist indefinitely. When it resolves violently. Be positioned before that day, not after. Number 3. The bearish risks are real, and you must respect them. Margin hikes, forced liquidations, and liquidity events can create short-term price destruction. If you are over-leveraged, you will get washed out regardless of how right the thesis is. Protect your capital. Size your positions responsibly. Physical metal in your possession has no counterparty risk. Paper positions do. Know the difference. The unresolved tension is this. JP Morgan has been fined, convicted, and documented as a manipulator of precious metals markets, and yet they continue to hold the largest derivatives position and one of the largest physical positions in the market. The question is not whether silver is manipulated. That has been proven in federal court. The question is, how long can the paper market maintain a price that the physical market has already rejected? And what happens to the holders of that $1.8 trillion derivatives book when the answer becomes 0 days? That is the question I want you sitting with until the next video. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Nothing in this video is financial advice. I am just a guy breaking down data that is publicly available but rarely connected in the way it needs to be connected. Invest with logic, not hype. VIP out.